Good morning and welcome everyone to our Saxo's Global Markets call. Today is Tuesday, 21st of March, and we start with FX Markets update from John Hardy.
Good morning, everyone. So the focus overnight was on this French presidential election debate where Macron was seen as sort of confirming his credibility as the likely winner in the second round. And you're seeing the spreads coming in on France to Germany sovereign debt, although only a couple of basis points. And more importantly, in the bigger reaction has been in the FX markets. You're seeing euro-dollar staring down this big 108 to 108.50 area, even as the dollar looks reasonably stable elsewhere. So, of course, a big focus on that technical level. I think, again, as I mentioned yesterday, the big dollar event risk this week is that Thursday vote in the House of Representatives on Trump's attempt to repeal Obamacare, as this is seen as sort of a litmus test on whether the so-called Trump trade, all of this anticipation about what's coming under President Trump, bid up the dollar in the wake of the U.S. presidential election last November. So, we have to take any technical move until we get that result across the wires there with a grain of salt. As well, other dollar pairs poised at key levels. Aussie dollar pulled back a bit overnight as the RBA minutes showed, same message as usual. RBA is sort of happy to peddle a optimistic message on the economy, but is really worried about housing risks, as are we. I think long term this is going to be a significant headwind for the Australian economy, if not worse, if not a disaster. Again, another dollar pair poised at a key level and waiting for those dollar-linked event risks. There was very little reaction to the Fed's Evans talking quite hawkish overnight, saying he could see a scenario where there are 4 rate hikes in total this year, but the market seeing his preference for not hiking more than is currently priced in as the key here, and actually the rate expectations settled a bit lower. So on the calendar today, as we know, or very little in the way of U.S. Event risk, we do have a couple of Fed speakers, neither of which are voters. Potentially Bank of Canada could be getting restless on the rate front, considering how good some of the Canadian data has been of late. So keep that in mind, especially if we see a strong retail sales figure. And then the UK CPI. This one was very important because we did see that surprise mention of inflation and the dissenting vote from a Bank of England member, Forbes, last week, indicating that she's ready to pull she would like to pull the trigger now, and other members are looking at CPI with some nervousness because higher inflation will mean that they want to hike rates as well. So potentially, if we get a strong beat on inflation today, this could really trigger a big move on the pound. And the opposite of it's disappointing. There has been a bit of a bid put under sterling since last week, and that could disappoint those fresh longs. So two-way risks around that figure today. Keep that in mind. Otherwise, late tomorrow, early Thursday for the Southern Hemisphere, out in Asia Pacific, we have the RBNZ. No expectations around there. They've tried to put their rate outlook on ice until 2019. So I think the Kiwi will move on broader risk-on, risk-off themes, carry trade, etc., more than anything the RBNZ will say. Although there could be some margin for surprise if they express willingness to react to incoming data or something like that. And again, it's all about the Thursday political developments in the U.S. and that Obamacare repeal act for our next big focal point. And with that, I'll pass it along. Thanks.
Okay, we try again. Right, just a quick look on the commodity markets. We've seen oil settling down yesterday and today after we basically had the result from the cut data, where we saw that there was a record reduction in bullish bets in the week leading up to last Tuesday. So the market is more stable now. So the overhang of longs that we've been worried about for a while has been sharply reduced. The long to short ratio is now down to 4.4 against 10.3 just 3 weeks ago. So this means we can start focusing more on what else is happening, and there we once again have the U.S. inventory and production numbers on Wednesday tomorrow, which will be a key. Early surveys are pointing towards a renewed increase in inventories. API tonight will give us a guide ahead of that. But also OPEC looking to extend the production cuts beyond 6 months has been taken mildly positively this morning. I think it's actually negative because it does indicate that the medicine is still not curing the problem. The overhang of supply is not coming down fast enough, and extending a deal which is already fraught with trouble with lack of compliance from certain producers, extending that by another 6 months can only create will be a mammoth task for OPEC to achieve. Also considering the need to get Russia back on board for another 6 months, going against what, for instance, companies like Rosneft, the biggest oil company in Russia, planning to increase production this year. So how that's going to play out remains to be seen. Into this, we have Libya preparing to resume exports. So I think the upside at this stage still remains limited, but we're potentially just settling into a range here at the lower end of the range here, of the overall big range, the 50-60 range. Gold is also settling into a range. It failed to break above resistance yesterday at 1237, so we're seeing a bit of a retracement here. But the weaker dollar and the lower real yields after the FOMC meeting last week is keeping us neutral, but with a focus on the upside risk. So currently it's at 1220 to 1238, with the risks of 1261 if we break above 38. Soft commodities are going a different ways. So we saw a bit of a break up in coffee yesterday, and as well as cocoa, which continued the rally that started last week. Coffee has been finding support from news, especially from Vietnam, where local prices has risen to the highest since 2011 on lack of supplies, weather problems, which has been highlighted on a regular basis, has starting to impact prices there. And this has happened just at a time where funds have cut the net long to a 40-week low, so funds are not involved in this rally we've seen here. And if that continues to extend, then they will have to get involved, and that will give the market some additional momentum. And on the model breakout model, sugar is now short below 1184, and nat gas will go long above 312. That's it for me. I'll pass you over to the next speaker.
Thank you, Ole. And as we have Kim joining us today for the weekly technical update, I'll just keep this very brief. But generally, yields are taking a little bit down again, particularly in the US. Treasuries are trading stronger. The June hike chance is fading a bit. It's down to 40% priced at the moment, and with it, 10-year US Treasury yields also taking a step back. This is a very familiar chart. If you're a morning call regular, it's the trading range of the 10-year US, and you can see that we are back safely in the middle of this trading range now. We could even target a move down to 2.3% next. In Europe, the yields are pretty much unchanged for this week or the past 4 trading sessions. Bund has barely moved. There was some chatter yesterday from Bundesbank, also the German wise men, really not surprising, but calling for QE to end early. The bigger story, though, is of course in France, as we heard John talk about too. France should and is catching a bit today. The spread is 4 basis points tighter. It's still more than 60 basis points, as we can see in the chart here. Still more than 60 basis points to Germany. So if this trade catches on, there's obviously more potential for this to narrow. Although I saw one analyst reminding us this morning that Hillary Clinton also was seen as the clear winner of all the U.S. presidential debates. So this one is going to stay with us for the next month or so, up to the French presidential election. That's everything from us. Over to Kim.
Yes, thank you very much. We'll start out with S&P 500 like we did last time, and not much has changed really. The uptrend is still intact, although we see some weakness with the past few days trading. It was very crucial that we could close above 23.65 yesterday, which we did. We closed around 23.73-ish area. Excuse me. But the lower trend line, rising trend line here is still intact. but I will keep my eyes on 23.65 and eventually 23.54 for a bearish move or bearish trend turn here if we close below this level. We see a small lower high compared to this high, which is a little bit of a warning signal, but it wouldn't take much for the market to bounce higher. There is no divergence on the RSI, as you can see here. The highs on the RSI correspond nicely with the highs here and the lows here. So there's nothing in the indicators that doesn't tell us that we could not go higher. Also going into Q2. On the DAX, a little bit of the same story, really. Tested here yesterday, also the lower rising trend line. The technical picture here is a little bit different though. As you can see that we see some massive divergence on the RSI. RSI has been falling, the tops on the RSI have been falling here as the market has been moving higher. I would look out for a break of 11,930-ish level here. If you take out there, you see this very good consolidation around here. If we break that, close below that, we will go down and test the 11,480, 500 level very quickly after that. A new one I will have a look at, I think is very interesting. Look at this morning, Nikkei. Is forming this ascending triangle-like pattern here. As you can see, the rising trend line, the lower trend line here, has been tested a few times. This trend line here is horizontal. So a breakout from this ascending trend line, really nothing happened this morning. But if we break below this rising trend line, well, we're talking about 18,600 as the first support area, and definitely I would bet it would go down to there, but there's actually potential all the way down to 18,000. On the upside, if it breaks above these tops here, you can see they are more. There's about 3 or 4 of them just below 19,700 area. Well, then we are back on the to test the 20,000 again. Gold found support at 0.5 Fibonacci natural retracement of this long rising wedge here after the breakout. There's still potential for it to trade lower to the 61.8, which is around 1180. But as you can see, the Bollinger Bands are contracting at the moment. That could indicate that the bearish trend the bearish trend is over. However, there's a little bit of warning down here where you can see that the RSI is still bearish. So far it hasn't broken above 60, which if it does, then we are back in bullish sentiment. So look out for a break or a rejection of that. So if it gets rejected, we could see further sell-off. Just in the broader picture, the reason for my little bit of a bearish view here really is we're still below the 200 weekly moving average. We still have this, of course, it's historic, so it's a bearish engulfing. So that was a top and reversal pattern. So unless that area is taken out, well, medium to longer term, I'm actually a little bit bearish on the gold, or should you say neutral trading within this area here. As you can see, RSI got rejected here. We are trading just between here. So there was no divergence on the RSI. So Bill is still bullish and sentiment, and there's still a risk to move lower. Crude oil, to finish it off, bounced a little bit this morning, but as you can see, Bollinger Band still expanding as at least the lower one. It tells us that we are in the final stage of a bear trend, and there is still a risk that we could go down and test the around 45-ish level here. As you can see, the 76 retracement and the rising lower support line here. There's no divergence on the RSI, which also tells us, and also MACD that actually indicates to us that we could see lower levels in oil. So I wouldn't be surprised to see it test this and maybe also penetrate a little bit at the rising trend line here. However, look out for a move above the 94.62-65 level here, close above here, well then maybe we will trade higher around the 52-53. But I want to see that unfold before I would say this is the end of the bear trend. That is all from me today. Not much going on from my point of view on the FX. Pound is getting a little bit weaker again, so I expect the euro sterling to trade higher. Thank you.